It's a Friday night, four friends, one table, one bar tab. David reaches for his card first, like he does every time, because he's terrified someone will notice he's the one who can't really afford this. Alex waves him off and taps his own card, feeling generous, feeling successful, not realizing he is less saved right now than David does. Jordan is scrolling through a text from his accountant that he hasn't opened yet, because he already knows what it says. And Marcus, the one everyone at this table assumes has it all figured out, just put a down payment on a boat 3 days ago that he genuinely cannot explain to himself. Four friends, four incomes ranging from $50,000 a year to over $200,000. And by the end of this video, you're going to find out that the person you'd bet on to be rich in 10 years is probably not who you think it is. Nobody at this table would guess it just by looking around. David looks the most stressed, constantly doing quiet math in his head every time a round gets ordered. Alex looks the most relaxed, cracking jokes, ordering another drink without checking anything. Jordan looks the most put together, the one with the nicer watch and the confident laugh. And Marcus looks like he's already won, the one nobody would dare ask for money advice. But looks, especially at a dinner table, are the single worst way to judge anyone's actual financial position. And in about 10 years, this exact group photo is going to look completely different than anyone here expects tonight. Here's the uncomfortable truth hiding underneath this table. Income was never the deciding factor. What decides who ends up wealthy and who ends up quietly broke at every single pay grade is what happens in the 30 seconds after the money hits the account. David, Alex, Jordan, and Marcus are all about to find that out the hard way, and I'm going to walk you through exactly what each one of them needs to do differently, starting tonight, because odds are you're sitting somewhere on this exact same table right now. David didn't sleep great last night. He opened his banking app at 2 a.m., the way he does most nights lately, not because anything happened, just out of habit, like poking a bruise to see if it still hurts. He scrolled past the balance twice, then put the phone face down without solving anything because there was nothing new to solve. $3,400 hits his account every month after taxes, and by the time rent, groceries, and gas are gone, there's rarely more than $100 left. What's eating him quietly is a credit card balance around $6,000, almost exactly the national average, bleeding him over $100 a month in interest alone before he's paid down a single dollar of the actual debt. And it's not just the card anymore. David has 3 buy now, pay later plans running across 3 apps: a phone screen repair, a couch, and a pair of shoes he regretted instantly. Each looks harmless alone, 4 easy payments, 0 interest. Here's the trap. A credit card shows one number every month. 3 separate apps show 3 small forgettable ones that never get added up. Stack a few, and you've quietly built a few $100s a month of committed future income, which, strip away the friendly branding, is just debt in disguise. So David's homework tonight is simple. Open every app, pull up every card, and write every balance down next to its interest rate. Attack the highest rate first, minimums on everything else. This is the debt avalanche method, and nothing beats it at his level, because no legitimate investment reliably outpaces the guaranteed return of erasing a 20+% rate. It won't feel exciting, but that quiet, boring progress is what gets him off this table's anxious math. The second thing David needs to lock in, if his job offers it, is his full employer 401k match non-negotiable. A 4% match on a $50,000 salary is $2,000 free dollars a year. An instant 100% return before the market does anything. Some argue this should come before debt, and mathematically they're right. But behaviorally, David does better killing the high interest debt first, then locking in the match so the win feels real. Third, an emergency fund, but not the version everyone talks about. 3 to 6 months is the eventual goal, but chasing that first feels impossible, and David gives up before he starts. A realistic first target is 1 month. About $3,400 in a high-yield savings account, enough to absorb a flat tire without it landing back on the credit card. Fourth, once the high-interest debt is dead, the Roth IRA becomes David's best friend, since he's in one of the lowest tax brackets he'll likely ever see. Pay tax now while it's cheap, let it grow untouched for decades. The 2026 limit is $7,500 under 50, a stretch on this income. But even $200 a month started at 25 can turn into over $700,000 by retirement. The habit matters more than the number right now. And fifth, David needs to know what his hour is worth. 50,000 divided by roughly 2,000 working hours is about $25 an hour, the filter for every decision about his time. A side hustle is fine if it clears that bar, But the real unlock usually isn't a Saturday delivery shift. It's one certification that permanently bumps his salary to 55 or 60,000. That raise compounds forever. A weekend gig doesn't. But here's the twist. Even after all of this, David still isn't the one most likely to build real wealth over the next 10 years. Because 2 seats down, Alex makes double his income and somehow has less saved right now than David does. Alex genuinely believed he was doing fine right up until the moment he actually did the math. Remember him laughing at the bar earlier tonight, tapping his card without a second thought, waving David off like it was nothing? That's not confidence, that's just not having looked yet. He got a 12% raise 8 months ago, upgraded his apartment, started doing weekend trips again, leased a nicer car, and somewhere in there convinced himself that a bigger number in his job offer meant he'd automatically be saving more too. He wasn't. He checked his savings account balance 2 nights ago, expecting to feel proud, maybe even screenshot it and send it to his old college roommate, and instead felt something closer to dread because the number staring back at him had barely moved all year, almost like the raise had never happened at all. $100,000 doesn't mean what it used to either. The median household income in America sits around $84,000 right now, so Alex's salary is only about 20% above the middle. A decade ago, that same 6-figure number would have felt like real wealth. Today, it just feels fine, which is exactly the problem, because fine doesn't force anyone to be careful. Almost all of Alex's survival level stress is gone. Rent, bills, groceries, all covered with room to spare. And that's precisely why nothing forces discipline on him the way it does David. Overspend a little at Alex's level and nothing catastrophic happens that month, so there's zero natural pressure keeping him intentional, and lifestyle inflation slides in completely unnoticed, one nicer thing at a time. So here's Alex's first real fix. Flip the entire order of operations using something called reverse budgeting. Instead of spending first and saving whatever happens to survive, the savings gets pulled out the instant the paycheck lands before a single dollar touches anything else. On a $6,000 month, that might mean automatically moving $600 away first and living on the remaining $5,400 like that $600 never existed. The target to aim for is roughly 15% of take-home pay. If Alex is honestly closer to 3 or 5% right now, the real first step is just getting to 10 and building from there. Automate it so the money moves before he ever sees it and willpower stops being a variable at all. 15% of a $6,000 month invested consistently starting around age 30 can realistically grow past $2 million by 65. The second move is one almost nobody at Alex's income ever considers, and he only heard about it because a coworker mentioned it in passing at lunch one day. Opening a health savings account if he's on a high deductible health plan. This account carries what people call a triple tax advantage. Contributions lower his taxable income going in, the balance grows completely tax-free, and withdrawals from medical expenses come out tax-free too. The 2026 limits sit around $4,400 for an individual and $8,750 for a family. Here's the strategy that actually surprised Alex when he first heard it. Max the account, invest what's inside it like a retirement fund, and then pay today's medical bills out of pocket in cash, keeping every single receipt. There's no deadline on reimbursing yourself, ever, none at all. So if he contributes $4,000 a year and lets it compound at 8% for 30 years, that account alone can grow to roughly $40,000, and decades from now, he can hand over years of saved receipts and pull that exact amount back out completely tax-free whenever he actually wants it. Used this way, the HSA quietly becomes an extra retirement account hiding in plain sight, one his coworkers probably don't even know exists either. The third move is knowing his actual number. At $50,000, the question is, will I be okay this month? At $100,000, the real question becomes, when am I actually done? That number is simple. Annual spending times 25. Someone spending $60,000 a year needs roughly $1.5 million invested to be free. What genuinely surprised Alex is that the timeline depends far more on savings rate than on income itself. Saving 20% generally points to about 37 working years to get there. 30% drops that to around 28. 50% brings it down to roughly 17. A higher savings rate isn't just building the number faster, it's shrinking the number itself, because someone living on less simply needs less to sustain it. Alex's homework tonight is to actually calculate that number instead of guessing at it. But Alex still isn't the one carrying the biggest problem at this table. That would be Jordan, the one everyone assumes has it most figured out, who's never once had to calculate a number like Alex's, because he's been too busy avoiding a different one entirely. Jordan is the friend everyone at the table assumes has it completely figured out, and honestly, for a while, he believed that about himself too. Back at that table tonight, he's the one with the nicer watch, the confident laugh, the guy nobody would dare question about money. $150,000, a great title, a nice place, the kind of life that looks finished from the outside. But that text from his accountant sitting unread on his phone, 3 little dots that appeared 20 minutes ago and haven't turned into anything he's opened yet, is about a number Jordan already half expects. He's been avoiding it the same way you avoid a scale after a bad week, not because he doesn't know it's coming, but because seeing it in writing makes it real. His marginal tax bracket now sits somewhere between 24 and 35%, which means taxes, quietly, have become the single biggest expense in his life, bigger than his rent, bigger than anything else on his budget. And nobody at his job ever sat him down and explained what to actually do about that. The first fix Jordan needs is the backdoor Roth IRA. Past a certain income, roughly $153,000 for a single filer, the ability to contribute directly to a Roth IRA starts phasing out, and it disappears completely past around $168,000. The workaround is a two-step move. Put money into a traditional IRA where there's no income limit at all, and then convert that balance into a Roth. The one place this gets messy is if Jordan already has old pre-tax money sitting in an existing traditional IRA, because mixing the two triggers something called the pro rata rule, which can create a surprise tax bill on the conversion if he's not careful. Done right, though, this one move keeps the door to tax-free growth open even after the direct route has closed for him. If Jordan has RS-US from his job, restricted stock units, that's the second thing that needs a real plan instead of just letting them sit there. He's been treating that vesting notification email like a nice little bonus surprise every quarter, never actually opening the account to see how concentrated it's gotten. RS-US get taxed as ordinary income the moment they vest, whether he sells a single share or not. 100 shares vesting at $200 each is $20,000 added straight onto his taxable income for the year, no choice involved. If he holds the stock after that and the price climbs further, he'll owe capital gains tax on top of what he already paid at vesting. The general rule worth following: once company stock crosses about a third of his total investments, it's time to start selling shares as they vest and spreading that money into a diversified portfolio instead of letting his entire future ride on one company's stock chart and one bad earnings call from wiping out years of gains overnight. Third, Jordan needs to actually diversify what he's already sitting on. A common framework for high earners suggests roughly 80 to 100% in equities, while under 50, with a small 5 to 10% slice in something like precious metals or crypto for anyone comfortable with the swings, then shifting towards 60 or 70% equities after 50 to protect what's been built rather than keep chasing growth. A little international exposure alongside the core position rounds this out further. The principle underneath all of it: the younger you are, the more risk you can afford, and the closer you get to needing the money, the more the priority shifts from building it to protecting it. Finally, Jordan needs an answer to one specific question: pre-tax or Roth? Which one actually saves him more? For most people at his income, the honest answer is that their tax bracket will likely be lower once they retire than it is right now. That means maxing out a traditional 401k at the $24,500 limit can save him somewhere around $8,000 to $9,500 in taxes this year alone at his marginal rate, while a backdoor Roth running alongside it captures tax-free growth for later. Run both together, and Jordan wins twice. Less tax now while his rate is high, tax-free money later when his rate is likely lower. But here's where the whole "who gets rich" question flips completely on its head. Marcus, sitting at the head of the table, making over $200,000 a year, more than any of them, could easily have a lower net worth right now than someone making $90,000 who's been doing the boring stuff right for a decade. Marcus doesn't worry about any of this, and that's exactly what should worry you about Marcus. 3 days ago, Marcus put $5,000 down on a boat he'd never even test driven. Standing in a marina parking lot on a Tuesday afternoon, he was supposed to be working, telling himself he'd earned it. That a guy making his kind of money is basically expected to own something like this, and in some ways, he has earned it. $200,000 a year, a great house, a job everyone respects, the kind of paycheck that makes people at this table go quiet when it comes up. But here's the number that should genuinely shock you. Marcus earns $220,000 a year, and his actual net worth right now is lower than someone making $90,000 who's been quietly maxing out a Roth IRA and an index fund for the last 10 years. Income was never the story. Marcus is proof of that, and he doesn't even know it yet, because he's convinced his income alone protects him, that a number this big must automatically come with a plan attached to it. It doesn't. At his level, the game stops being about saving and starts being about tax efficiency, diversification, and not letting one bad decision undo 2 decades of good ones. Marcus's first real move, if his employer offers it, is the mega backdoor Roth, one of the most powerful and most underused strategies at this income level, often available at large tech and corporate employers. Roughly how it works. Marcus first contributes the standard $24,500 limit into his regular 401k. Then, if his specific plan allows it, he can put significantly more, sometimes over $40,000 additional dollars, into an after-tax account inside that same 401k and convert that balance into Roth through an in-plan conversion. Done in full, that can mean putting away somewhere around $67,000 of his own money in a single year, a scale of tax-advantaged investing that simply doesn't exist at any of the lower brackets. A standard Roth IRA alone caps out at a few thousand a year. Even a max traditional 401k plus a backdoor Roth IRA together only lands in the low 30,000s annually. The mega backdoor Roth is really the only legal path that pushes total Roth-style contributions past $60,000 a year, and over 2 decades of consistent use, that gap alone can be the difference between comfortable and genuinely wealthy. Most people at Marcus's income never even ask their HR department if it exists. Second, Marcus needs real diversification beyond stocks and his core retirement accounts. At this net worth, real estate, whether through rental property or REITs, and potentially a stake in a business, start making sense as part of a broader plan so his entire future isn't riding on one asset class or one employer's stock chart. Third, Marcus needs asset protection and an estate plan that actually matches what he's built, and this is the part he's genuinely never thought about, because for most of his life, there wasn't much worth protecting. That changes fast once the numbers get big. An umbrella insurance policy stops being optional here, because it shields everything, the house, the savings, the boat he's not sure he needed, from a single lawsuit or accident that could otherwise wipe out a decade of progress in one afternoon. A will at minimum, with a trust depending on his situation, makes sure what he's built passes on exactly how he intends, instead of getting tied up unnecessarily. Fourth, Marcus should be sitting across from real professionals, a fee-only financial advisor legally required to act in his interest, and an actual tax strategist instead of a seasonal preparer. Because at this income, the cost of good advice is small next to the cost of the mistakes made without it. Right now, Marcus is basically making 6-figure decisions with the same casualness he'd use ordering appetizers, and at some point that stops being charming and starts being expensive. And fifth, Marcus has to fight the exact same lifestyle inflation trap as Alex, just at a much bigger scale, where a bigger income quietly funds a bigger house, a bigger car, and yes, apparently a boat, until a high income somehow produces almost nothing actually saved underneath it. The shift Marcus needs to make tonight is treating his income as a tool for building protected, compounding wealth, not just a bigger budget for a bigger lifestyle. Back at the table, the bill finally comes, and for once, David actually reaches for it first, not out of guilt this time, but because he did the math earlier tonight in the car and knows exactly what he can afford without flinching. Alex waves him off anyway, still a little too fast with his card, still not quite ready to look at the number he's been avoiding. Jordan finally opens that text from his accountant under the table, reads it twice, and quietly starts typing a note to himself about a call he needs to make Monday morning. And Marcus laughs a little too loud at something, still thinking about the boat, still not entirely sure why he bought it, already half planning to sell it back before the season even starts. That's really the whole story here. Look at David, Alex, Jordan, and Marcus side by side, and the strategy is completely different at every single level, but the theme underneath never changes. David is playing defense, building a foundation strong enough to stand on. Alex is playing automation, taking willpower out of the equation entirely. Jordan is playing tax efficiency because at his level, taxes are the biggest line item he has. And Marcus is playing protection and compounding, making sure a great income survives its own owner. None of them needed a bigger paycheck tonight. They needed a plan, and honestly, so do most people watching this right now. If you saw yourself in David, the point isn't that your income is the problem, it's that the system was missing, and that's fixable starting tonight, one debt, one balance, one automated transfer at a time. Tell me in the comments which one of these four you actually are, David, Alex, Jordan, or Marcus, and what your own number looks like once you actually calculate it instead of guessing at it. Subscribe if you want the next video, because next time we're sitting back down at this exact same table 5 years later to see who actually followed through and who's still doing math on their phone at 2 a.m.